Do you have a pension? Have you been told all your life that you'll be in a lower tax bracket in retirement? As you know, if you have a pension, that's probably not going to be the case because you've got a guaranteed income stream coming to you and being paid to you every single month for the rest of your life. And you may also still have Social Security on top of that. And then we have what's called a required minimum distribution that you're required to take at either 73 or 75 from your investments. That's when Uncle Sam forced you to take out money. And now you're going to be left with probably more income or the same as while you were working, and that's going to lead you to pay more in taxes. And so we're going to show you today of how you can start planning for this, what to be aware of, and what are some strategies that we can start doing if you have a pension to put yourself in the best position moving forward. As you all know, I wrote the Amazon best-selling book, I Hate Taxes, and there's a lot of tax planning strategies in that book to ensure we pay the least amount of money in taxes. And so we're going to open the book to some of those chapters today to making sure that we are planning for this increased income that we're going to have through not only pensions, but also from higher amounts in our required minimum distribution. So if you've got tax-deferred dollars of $1 million or more, then this is going to really start to be a big point for you as you plan for your retirement moving forward. So the first chart I want to show you here is what's called the federal income tax rates. And so you'll see here that there's the 10%, there's the 12%, there's the 22%, 24%, and so on. And so you have to see where your pension is going to put you here. And then there's something on the right here. So before we do that, let's talk about that standard deduction. So that standard deduction is the amount of tax-free money that you have up front. And so if you are married, you have $29,700 of income, you don't have to pay any tax on that money. So if all you have is a pension and it's $29,000, nothing else, then you do not have to pay federal taxes that year. Now, if your pension is $50,000, well, you're going to eat up that $30,000 if you're married, and you're going to have that amount tax-free of your pension. And then that next $20,000 is start to be subject to the tax rates on the screen that I'm showing you there. And then that's automatically going to put you there no matter what moving forward. And then you look to add on your investment withdrawals or your RMD, as I've talked about earlier, and then that's only going to push you up the brackets. And so you can easily tell where you're going to be from a federal income tax bracket on that screen right there. Now, here's the question I have for you. Does that perfectly show you what your tax situation is going to be in retirement? And the short answer is no, because there's other considerations that we have to plan for, such as Social Security tax, such as Medicare premiums, such as capital gains, such as net investment income tax, AMT, credits deductions we may phase in out of. All of these things are going to play together. And so I'm going to talk about some of those things that we need to be planning for in addition to this federal income tax bracket that we're talking about to make sure that you understand if you have a pension, all of those different types of taxes, you're going to be more likely to be subject to them because those taxes, those penalties that we just went through are more subject for those with a higher income amount, which if you have a pension, you're going to find yourself there most of the times that we see. So let's show this capital gains slide here, and this is going to talk about the capital gains rates. And so you'll see there 0%, 15%, and 20%. Now, if your pension is $50,000, since we've been using that number so far, well, then you only have about $40,000 more of room to maximize that 0% capital gains bracket. And if you're going to have Social Security and you're going to have an RMD, let's say you have $1 million, your RMD is going to be $40,000 if you're 73 currently. And if you're 60 years old, by the time you're 73, that RMD may be $80,000 because maybe your $1 million will double to $2 million by that time. And so you're not going to have this 0% capital gains opportunity because of that pension could be something that you need to understand. And so again, understanding the impact of pensions doesn't just impact your federal income tax brackets, also impacts capital gains. Here's another one for you. What about Social Security tax? And so Social Security tax is a bit more complex. With Social Security tax, it's going to be based on your provisional income. Now, provisional income is a multitude of things added together. It's not on that federal income tax bracket. It's not on that capital gains bracket. It's a totally different calculation that the IRS uses to see how much of your Social Security will be taxable or not, because Social Security could be tax-free. And so if you find your income from Here, for example, your Social Security is tax-free. All that money, that $3,000 that Social Security is going to give you each month, is now in your pocket. You don't have to give any up. If you find your income from this point higher, well, now you're going to start to force your Social Security to be taxable. Maybe 10% could be taxable, then 20%, 30%, 40%, 50%, all the way up to about 85% of your Social Security could be taxable. So if you're married, let's just say you have $100,000 of Social Security, $85,000 could be counted as income, on top of a $50,000 pension, on top of a $40,000 RMD, and that's where you find yourself in a very high income tax bracket from all of these things playing together, as I've been talking about throughout this video. And so this is what we call the Social Security tax torpedo. And again, if you already have a pension, you're probably not going to be able to get Social Security tax-free because your provisional income is going to be too high. So your provisional income includes half your Social Security. It includes any IRA distributions, pension withdrawals, any earned income if you're still working, and then it also is going to include any capital gains, dividends, and also any taxable interest. And also any muni bonds, any tax-free interest there as well is all going to be added together. And then you're going to take that number to the Social Security provisional income chart to be able to show how much of your Social Security is going to be taxable. And again, if you're going to find yourself in a situation where you have a high income, you're probably going to have the majority of that be taxable. Now, what if there's a way that we can reduce that RMD so that maybe we move money to a Roth, which we'll talk about later throughout this video? Well, now we could potentially back down our income on paper while still living on what we want to live on. And now we're not having as much Social Security subject to taxes, and we're going to save some money there. And we're also going to save some money from a federal income tax standpoint, because every extra dollar we take out is going to be at a lower bracket because less of Social Security will be taxable. So that's one of the big ones that we always want to pinpoint to people. And then another one here is when it comes to Medicare premiums. Again, Medicare premiums are based on your income for Part B and D. And so Part A, that's no cost. That's what you've paid into for all your life. And then most people get Part B on top of that. And Part B is going to be based off your income. And so the base here, you're going to have to pay about $170 this year for Medicare Part B. And then as your income increases, you could pay 2 times, 3 times as much more just because of your income being higher. And as we've already shared, if you have a pension, you're going to find yourself in a higher income situation. Remember, Social Security is now taxable, pension, the RMDs. Now you're going to potentially push yourself into paying higher Medicare premiums in the future. And again, that's something we want to avoid because there's no use of paying more for healthcare while getting the same coverage as everyone else throughout a retirement. So I know I've been doomsday. I've known I've been showing you all of the issues of having a pension and the impacts it can have to all these different taxes. So what do we do about it? Do we just sit still and not do anything and hope for the best? Of course not. Now it's where we start to be proactive in the type of planning that we were looking at here. And so a lot of things that we're doing for our clients right now who have pension, this is an area of specialty for us, is we're looking at strategies such as a Roth conversion, for example. And with a Roth conversion, let's say we have $1 million in tax deferred. Well, we're going to have to pay taxes on all of that $1 million at some point in our retirement. Well, what if we just took this $1 million, maybe not all of it, but what if we just took parts of it every year for so many years? We just have to run the calculations to see what the optimal amount is to convert. And we just moved it from the tax deferred over to a tax-free investment such as a Roth IRA. Now, if we do this, I'm missing something. It's not that simple. We'd have to pay taxes right now. And I always ask people, do we want to pay taxes right now? Well, of course we don't want to pay taxes. We always want to pay the least amount possible, but we have to pay our taxes on this tax deferred. So we either go to jail for not paying them, or we can start to pay them now at known rates when we consider tax rates to be the lowest that we're going to see over our lifetime, in my opinion. And so if that's the case, and we know that tax rates are going to go up in 2026, well, that leaves 2 years that are really going to be optimal times for many people with a pension to look to convert. And so that's something that we're looking to implement with a lot of the clients that we're working with right now. And then we're going to have to put together a plan of what do we do after those 2 years. But we don't know exactly what's going to happen yet because tax rates are unknown. Anything can happen to tax rates in the future, and many experts expect that they could double just to keep up with the debt crisis that we currently have. And so if that's the case, and you have a pension and Social Security and those RMDs, you're going to find yourself in a lesser situation in the future than potentially that you could see right now. And that's why proactive tax planning with strategies like that can really help your situation and not only pay less in federal taxes, but also capital gains like we went through. Allow more of your Social Security in your pocket, less than Uncle Sam's. Also allow you to pay that base Medicare premium tier so you don't have to end up paying more for healthcare for the same coverage. But you have to act now is the idea. And so if you're looking for this type of planning, and this type of planning is what you think you need to be more successful throughout your retirement, feel free to reach out to us. You can do a call with our team here to see if we could potentially serve you ongoing, or at least give you some guidance to see if we could be a good fit or not. And if you just go to the description of this video, then you'll be able to see that link there to pick a time and see how we can help. And there's also going to be some other videos on our YouTube channel page that you can watch on similar topics. Some of our most viewed videos on pensions. If you have a pension, you're going to find those helpful as well. And so feel free to leave a comment as well of what you'd like to see more videos of, and we'll make sure to keep them coming. So have a great rest of your day.